Hello, I'm Bruce Ball. I'm VP of Tax for CPA Canada. And welcome to our presentation today on running a high-level tax practice. I also have with me today three other speakers who will be joining me in the discussion. Malcolm D'Souza is Executive Vice President of the CPA Professional Liability Plan, Inc. Sandy Stedman is a partner with Shibley Stedman King in Victoria. And John Oakey is National Director of Tax Services for Baker Tilly. There's a bio for each of our speakers in the conference materials. Tax is a key service that many members provide to their clients and their employers. At the same time, it's an inherently risky area of practice. This is due to a number of factors. The tax rules have always been complicated, and of course, the complication has grown in recent years. But this is also obviously the value that we bring to the table. We can help our clients navigate these rules and make sure that they are properly reporting their taxes and doing tax planning that's appropriate for them as well. Taxpayers' affairs have also become more complicated as time goes by. They're often in more unique situations that arise, and we see a wider variety of potential issues that are related to tax, and perhaps having to determine how new things are dealt with from a tax perspective. I think the other area that tax is different, and this discussion I've had with many people over the years, an error in tax generally means that there was an underpayment or overpayment or over-reporting of tax, and both of these carry concerns. There are some tax errors that may not result in an immediate financial implication, but many do. So that adds to the risk and the reasons why tax has to be taken very seriously as an area of practice. The other thing, if tax errors arise, are issues related to the client. Could be a loss of a client, loss of productivity dealing with the issue, or other financial issues. Having an error arise, and for those of us who've gone through it, it's not a pleasant experience either. So it's always a good thing to try and avoid errors as much as you can. Our goal today is to discuss specific risks that a CPA practicing in tax could face and some ideas for dealing with the risk. One other thing I'll mention, though, is that many of the suggestions we'll have today will also make your practice more efficient. Just as an example, one way to reduce tax risk is making sure you work in areas that you have a fair bit of experience with. This also helps with efficiency as well. If you stick to things that you're well acquainted with, you're much more efficient versus other areas that you may not deal with very often. So our focus today is going to be on practical ideas that work for small and medium-sized practices. Now, as we go through our story today, we want to make sure we focus on best practice suggestions that will improve your practice, as opposed to discuss horror stories. Our goal today is to keep the discussion as positive as we can, and hopefully you'll walk away from the presentation with a number of ideas that you can use for yourself. At this point, I wanted to turn it over to Malcolm D'Souza to discuss the most significant areas of tax risk that he sees from his perspective.
Thank you very much, Bruce. The beginning of this presentation will feel a little bit like a horror movie, but it will soon become one of those Hallmark feel-good movies thanks to Sandy and John. So recently, the courts have made it more difficult for accountants. In the tax area, rectification was a very common resolution solution that we used to mitigate tax damages. So when a claim was advanced against an accountant, they reported to their insurer, and we would use a commercial court tool called rectification. And that tool allowed us to go to the courts and say to the courts that the intent of the taxpayer was not reflected in the transaction. And the courts would allow us to redo the transaction to reflect the intent of the taxpayer. This gave us 100% success in resolving some of the simple tax matters like capital dividend claims and Section 84.1 claims. But what happened in the courts was two cases were taken to the Supreme Court of Canada, one Jean Coutu, one Fairmont. And both of those cases, CRA contested the rectification. CRA was successful. And since then, it's been much more difficult to use rectification as a tool. So in the past, because CRA would not contest a rectification, it would be a $10,000 solution that would mitigate and resolve the tax problem. Now, because CRA is contesting everything, it's like a trial, so the costs are $150,000 plus. And we went from having 100% success to now having less than 50% success in matters that we do take to rectification. So this has made it more challenging to resolve any tax problems that have been reported by accountants. And in the tax area in general, there has been a huge increase in claims. So tax claims have more than doubled in the last 10 years. And within that, there's a subset that's become very alarming, which is estate planning claims. So in the last 5 years, estate planning claims have more than tripled. So the areas of claims where we see most often in the tax area is estate planning, capital dividend, Section 84.1 deemed dividend, subsections 15.1 and 15.2, subsection 55.2, R&D tax credits, dividend refund claims, and cross-border claims. For all of the claims that we receive, there's a common theme, and I believe John, Sandy, and Bruce will be talking about these common themes. But really, documentation, education, and communication are the 3 keys to avoid a claim or to have a fair and quick resolution of a claim. And I believe that these 3 themes will be hit home by both Sandy and John and Bruce, but they are the key to avoiding or quickly resolving a claim. Thank you.
Well, thanks, Malcolm. So how we've decided to sort of do the rest of the presentation, Malcolm mentioned a number of risk areas. Unfortunately, we just won't be able to cover all of them, but we decided we pick 2 that are of particular concern, but they're also a bit different as well. One's what I would call a more focused technical area, and the other is more general. So our more focused topic, we decided to pick capital dividend account calculations and capital dividend elections. And we are going to talk about estate planning too, but highlight some things, maybe not so much of a technical nature, but of in terms of best practices and bringing in some of those points that Malcolm mentioned on communication and that sort of thing. So we're going to start the discussion with the capital dividend account. And as Malcolm mentioned, it is an area that has resulted in claims over the years. It's a very technical area. The calculations are very specific. It's also probably, I would say, when Malcolm talked about rectification, maybe the one that was affected the most by rectification, because changing perhaps the amount or the date of a dividend was relatively easy before, and now it's not. So I think that's a key thing to keep in mind too. When working on capital dividend elections, a lot of care is going to be needed. So there are a number of issues that could arise, but the biggest concern that'll come up is you declare a dividend that's larger than the capital dividend account balance at the time the dividend's declared. This could be because of just a miscalculation of the account, or it could be because of a timing error as well. Now, it's interesting because whenever, unfortunately, this comes up, my experience in the past is people say, well, can't we just revoke the election? And the key here is that you declare a dividend first and then you elect on it. So the issue is if the dividend you declare is too large, you have a penalty or an issue, and that's where you need rectification. But of course, in tax, some CDA, capital dividend account situations are relatively straightforward and others aren't. And maybe the first thing to talk about, and I'm going to direct this to Sandy, is can you help us, how do you approach it? How do you separate the more routine situations from the more complicated ones? And what are the sort of things that you really watch out for when you're doing this work for clients?
Well, Bruce, I think I've got 2 areas that I'd like to say I really watch out for. One is new clients, and the other is when I have components in more than one of the buckets of this capital dividend account. new clients are really problematic. You just don't have the history of what's gone on to be sure that the capital dividend account that you're looking at is correct. And you know, the things I look for on a new client is there any indication there was a reorganization? Do we have a complicated corporate structure? And windups can be particularly problematic, and it is difficult to tell if there has been a windup, and the client's recollection may not be bang on. You can go and I confirm with the CRA what the capital dividend account is. You can send in Schedule 89 once every 3 years. And so the first thing I do is see when's the last time somebody checked what the capital dividend account was. If my predecessor paid a capital dividend, then I can look and say, well, did that one get accepted and everything was okay then? And that at least will narrow down my focus on when there may be a problem. I try to be really careful when there's a real time pressure on getting the capital dividend paid on a new client. Like you've acquired a client, you've got a massive shareholder loan debit, and you think you've got a big capital dividend account, so you'd like to run that out. Or there's a pending significant capital loss and you'd like to run the capital dividend out before the loss happens. Those are the times you're more likely to make an error because there's some time pressure and you're rushing through and really short on the knowledge. And it is important to remember that Schedule 89 doesn't get e-filed. The CRA doesn't get it unless you send it in. And so the fact that they assess the return is filed doesn't mean they're agreeing with the CDA calculation. And this is where Malcolm's point on communication comes in. You need to make sure the client understands what information you're relying on and what the risks are in terms of the accuracy of that information, so that if something is wrong in the calculation or in the history and nobody knew about it, it's clear why that issue arose and that the client knew about it when they agreed that the dividend was a good idea. The other area, and a more technical one where I see a lot of problems, is remembering the capital dividend account has the 4 buckets: capital gains in excess of capital losses, capital dividends received, cumulative eligible capital, which, while it doesn't exist anymore, the CDA component does, and finally the life insurance. Anytime you see multiple buckets having a capital dividend balance in it, you want to look at how the components work together, the 4 buckets. And CEC and the life insurance ones are definitely ones where I put a little extra care into it because you don't see them that often. So those are the 2 areas that I think are worth being concerned about.
Well, thanks, Sandy. That's a great summary of the things to look for going into the calculation. The other thing that we wanted to bring up, and I think John and I actually both mentioned this when we were preparing, I think both of us have seen it's a lot more common to use trusts these days that have corporate beneficiaries. So if you're trying to pay out a capital dividend and it goes through a trust, that brings new issues into play. And John, I think what we were talking about is just you know, timing and other things to consider. Can you elaborate on what some of the issues are?
Yeah, sure. Thanks, Bruce. So, you know, as Sandy was talking about, you know, you have the capital dividend accounts made up of a multitude of different buckets. And it's very important to understand that each one of these buckets legislatively are dealt with differently. There's different legislation all contained, you know, under 89 sub 1. Well, you also have to be careful certain non-routine type of structures that you have in place. So if you have, for example, you have an operating company, and let's say it has a June 30th year end, and then you have, you know, and that operating company is owned by a family trust that has a December year end. And then you have a holding company, which is a corporate beneficiary, also with the December year end. It wouldn't be uncommon for you to think that, well, if I have a capital gain, you know, in my corporation, and I declare the cap, you know, and 50% of the capital gain goes in my capital dividend account, and I declare a capital dividend from my corporation up to my family trust, and then I allocate that over to my corporate beneficiary, that if I did this all on, let's pick a date, September 1st, and I flowed this all up, the very next day, I should be able to take a capital dividend account out of my holding company directly to the shareholders. That would make logical common sense, but technically, the capital dividend account of the corporate beneficiary does not receive, for capital dividend account calculation purposes, doesn't receive that capital dividend until after the taxation year for the trust. So there is a timing issue where you're actually paying a capital dividend out of the holding company, which is a corporate beneficiary, but it actually doesn't have access to that capital dividend yet because of the timing issue. And then you can also get into a timing issue where you have the trust, and the corporation declares a capital dividend to the trust, and nothing is done in that year. So, we have a December year end for the trust, and it has in receipt a non-taxable capital dividend, which is income to the trust. But if it doesn't do anything in that year, it doesn't actually pay out and designate that to the corporate beneficiary, it just sits there. Well, the following year of the trust, that becomes capital property to the trust. And if in the following year you say, well, I want to designate that capital dividend to the holding company, it doesn't work because you've missed out on that taxation year of the trust. It's capital property. It's not taxable. It goes to the corporate beneficiary, but you can't add to the capital dividend account of the corporate beneficiary. So these are little things that, the actual capital dividend account, although it's sometimes just mathematical calculations, you get into some weird stuff when you have different type of structures and when you involve a trust. And it becomes really important to, go back to some of the things that Malcolm was saying, where education is important. You need to know and understand how the capital dividend account is calculated. Putting a checklist in place to make sure you have a proper system to pick up on these little things that you might just forget about. And probably one of the most important things to do is, if you get into these non-routine type of structures, you really need to have a tax specialist approve the actual calculation. So it's not sufficient just to have the education on knowing what to do. You really need to have somebody with a specialty in this to be able to prove that process as well.
Yeah, thanks, John. That's a good, really good review of the topic. You have to get the timing right. Too early or too late can cause you a problem. On the mention of a checklist, I'm going to talk about resources at the end of the presentation, but one thing we're in the process of finalizing, so it might be a little bit yet before it makes it into our practitioner package, but we're working on a capital dividend checklist, and we definitely are discussing those issues in there in terms of making sure that they're dealt with. So a good review on a technical issue. Now we're going to switch to something that's broader and maybe bring in some other risks that can arise as well. We're going to talk about maybe just communication things, but also a bit on technical issues as well. So, Malcolm mentioned estate planning is just growing in terms of a risk area. And I think that makes a lot of sense if you think about it. We have an aging population. Again, people are doing more complicated things than they used to do in the past. Use of trust, for example, are more common than they used to be. Anyone who's dealt with it knows that passing away with a private company causes a number of complications that have to be dealt with. So there are a number of factors. And I think one of the concerns as well is the meaning of estate planning. What does it mean if a client asks you to do estate planning for them? I think if I were to ask Sandy and John and I gave an answer, we might have slightly different responses because it isn't really defined. It is kind of what you make it out to be. And the other thing is, what is your client expecting if they've asked you to do estate planning for them? So, John, maybe we could start just at sort of the, more at a higher level. What are some of the things if a client comes to you, what are the things that you think about and make sure you address when you're going into an estate planning engagement?
Well, I think the first thing comes around, what is estate planning? I mean, you mentioned this already, Bruce, and it's kind of like when you go up to a lawyer or just to somebody and say, hey, what do you do as a profession? They say, I'm a lawyer. Okay, well, what does that mean? Are you a property lawyer? Are you a criminal lawyer? Are you a corporate lawyer? Your tax? There's many different facets that come from that. Well, estate planning is the same thing. So when somebody comes and says, look, can you do some estate planning for me? And I, promote myself as a estate planning expert. Well, what does that mean? Am I helping transition the business? Am I helping transition estate assets? In some of the issues you can run into is, when you do consider, the distribution of estate assets in a business, are you to be fair and equitable? Because they're two different things with regards to distribution of assets through an estate. Are we talking about inter vivos planning, or are we talking about post-mortem tax planning? Are you also considering advising and helping the spouse and the children with the succession of the business, which gets into more an advisory role. Is one of the objectives tax efficiency? So just looking at the most tax efficient way of transferring estate assets to the next generation or to the spouse, or are we talking about asset protection? Maybe tax efficiency is not really relevant because there's a child that, can't manage money or can't manage assets. So we're really looking more of an asset protection strategy as part of the estate plan. And so when somebody says we're doing estate planning, there's a lot more that needs to be involved here. You really got to dig into this, and you really have to know who the players are involved. You have to know the parents, you have to know the children, the grandchildren, you have to know what other beneficiaries are going to be involved, because there are a lot of people out there that will name not-for-profits as a beneficiary to their estate, or charities. And there's probably lots of lawsuits out there that where, charities and not-for-profits are saying, hey, we didn't get our fair share, or vice versa, that the family's saying, well, hold on, they shouldn't be getting that, we should be getting that. And if you say, well, I'm doing estate planning, all of this comes into this, and you really have to make sure that you know what's going on. And another example of a situation that you can run into is, where you're trying to figure out, well, who's really engaged me to provide estate planning? Is it the mom, the dad? Is it the kids? Is it the grandparents? Because, perfect example where, it's a family business, mom and dad control the business, but the 3 kids have a 50% equity stake in the common shares of the company, but it's mom and dad that are coming in saying, look, we want to do some estate planning. Well, if your estate planning is in relation to the company, which the kids have a 50% equity stake in, well, shouldn't they be involved? And so that's another factor in, as well as who's actually engaging you to do the estate planning, and what other stakeholders are party to the overall objectives that should be part of the whole conversation. And it kind of brings me to, if somebody comes in and says, look, I need some estate planning done, there's some things that I'm going to make sure. One is, I don't want to do any estate planning unless I actually know what I'm talking about. That's the first thing. And there's various different elements of estate planning. And I'll be the first one to say, I don't know everything there is to know about estate planning, because there's things that are just outside my realm of expertise. So I'm going to have a lawyer involved. I'll probably be the tax specialist, unless there's areas of specialty that I need somebody else because it's beyond my expertise. You might even have to include a psychologist, or maybe a family enterprise advisor, just to make sure that what you're putting in place isn't purely focused on tax, it's focused on other elements as well. Client communication is going to be extremely important. I will absolutely have an engagement letter, and you have to make sure you know who you're being engaged with. You also want to have healthy conversations with all the stakeholders. It's not sufficient just to talk to mom and dad, because the plan can fall apart once the kids hear, well, hey, Sue is getting more than I'm getting, and that's not fair. And so you really have to have healthy discussions with all the stakeholders and that are part of this. And checklists. I know Bruce is going to talk about this at the end, but I'm a big believer in a checklist is just an opportunity to allow you to not forget things that need to be done. So you should have a detailed estate planning checklist. You should have a detailed know your client checklist. And the last thing I'd say that is really important is documentation. So you can put all this stuff in place, but every once in a while, something may go awry on you, and you need documentation to support, hey, this is what we were trying to do. These are the objectives of the client. This is what they wanted to have. And the documentation is what's going to save you afterwards.
Yeah, thanks, John. That's a great summary. I have to say, I think we've probably all run into those issues. I remember the key one I remember hearing from someone is, how many times have you had a detailed estate plan that they never implement? And it's probably because you haven't discussed some of the, and I hate calling it this because it downplays it, but many call it the softer issues. But the soft issues are often the key issues that you have to deal with first. Now, getting into a little more detail, when we were doing our preparation for this, Sandy, one thing that he wanted to talk about was the importance of understanding when you need to use clearance certificates. Or maybe there are situations where it's absolutely needed, and maybe some others where it's not so much. But Sandy, I think you were saying that you see a lot of misunderstanding out there on getting a clearance.
I think, Bruce, that I see 2 types of misunderstanding. One is everybody wants to distribute early, and the executor is getting a lot of pressure from the beneficiaries. And inevitably, the strongest pressure is from the one who, if you distribute early and you distributed too much, he isn't going to have the money anymore. And so I think that our job is to, first of all, understand who our client is. And if we're acting for the estate, the executor is our client. That's who we're talking to, and the beneficiaries are not. And if you think about what John talked about in terms of who all's involved in this, probably the beneficiaries, or a good chunk of them, actually are your clients. And so you do have a conflict going on there. And it's important that you understand that the clearance certificate protects the executor. If the executor distributes without a clearance certificate and they get assessed for more tax, the executor is the one who's going to pay the tax, not the beneficiaries. And so it's really important to advise the executor clearly what their exposure is. They're getting pressure. They're asking you, gee, can we, distribute a bunch of money now? What's the chance we could owe the taxes? And you need to make sure they understand the risk and that it's their personal risk, and that they know what they're doing, and they're your client, not the beneficiaries. The other thing we were talking about during the planning for this session is people who go for clearance when they don't need to. And so if you're in a situation where a clearance certificate isn't going to give you any protection, and the easiest one there is the executor is the sole beneficiary. Dad dies and mom's the executor and the sole beneficiary. There's no need to get clearance because mom's not getting off the hook on anything at that point. And so you might as well just wind things up and keep going rather than dragging the process out with more paperwork. So first lesson on a clearance certificate is if you need it, you really need it, and you don't distribute the money until you've got a clearance certificate. And the second one is make sure you know whether or not you really need it. And there are lots of cases that we're going to deal with that don't. So I think that the postmortem part of estate planning has got just as many pitfalls with the family dynamics as the stuff John was talking about. And so when you do get to that situation, make sure you're ready for the pressure. And I guess it's your chance to help the executor, because if nothing else, they can say, well, I would give you the money, but Sandy said I can't.
Well, that's a good way to put it. As I said at the beginning, we can't cover everything, but Malcolm did mention, if I could quickly mention that one thing he also sees, unfortunately, is situations where a trust has been set up and the attribution rules, in particular, the rule under Section 75 sub 2. The rule of thumb I always have told people over the years, I guess, who aren't tax specialists, if you do everything a client wants you to do in a trust agreement, there's a pretty good chance the attribution rule arises, because combining control and the ability to get property is what's likely going to put you offside. So you have to be very careful when trusts are set up. And also, if you want to do a rollout from a trust as well, if that attribution rule is applied, that could cause problems. So unfortunately, there are a lot of things to look at. As John mentioned, I'll just plug this here very quickly. We are putting together a checklist for estate planning too. This one's going to be a little more tricky for us because we can't possibly cover everything, but I think what we're going to try and do is sort of highlight some of the examples of key things that John and Sandy have mentioned, and bring in others as well of the key things that you need to consider when you're doing an estate planning engagement. So we're going to move on. I thought we were thinking when we put the presentation together that maybe we should also have each of us maybe just sort of say, and this is unfair for sure, but if I put the three of us, Sandy, John, and myself on the spot, if you could only talk about one key risk management practice or technique in particular, what would it be? And I'll start with Sandy.
Well, I think, Bruce, that the one thing I want to talk about as a good practice is documentation. And I know Malcolm mentioned it as one of his three things up front, but and getting in the habit and staying in the habit of doing it well. And it's more than just having checklists. There's a lot of day-to-day documentation. And so, for example, anytime you phone the CRA, you want to document that call. You want to document what the CRA said, and you can bet they're documenting it. And you need the date, you need the agent number, You don't need a verbatim transcript, but you need to know what they said. And especially if you're talking to a more senior person or, you know, an audit situation, something like that, those things are really important. And when you're thinking of documentation, remember that email is a document. And I find that people tend to approach email like it's a casual conversation. And if you're starting to send emails where you've got some technical content to it, you should approach writing that email like you would be writing a letter that was advising somebody on it, because that email is not going to go away. And you can delete it out of your outbox or your sent folder all you want. The other person's got it. And I've certainly seen lots of cases where a misspoken email came back to haunt us. So you want to be careful. I'm kind of keen on memos to file. I think that they're a good opportunity to lay out why you did what you did, even if it's not a planning memo that the client looks at. Unless your memory is really good, a memo to a file is a great thing to have 3, 5, or 10 years down the road when you're trying to remember why you did something, or that you want to make sure you don't do something. You know, thinking of the earlier discussion about attribution problems, you may want a memo in the file that says, by the way, never do this on this one because. So documentation is really what I would say is the practice I would focus on as the most important.
Yeah, thanks, Andy. John?
All right, thanks, Bruce. Slightly annoying that you're telling us we can only pick one. You know, I could sit there and literally take everything Sandy said and reiterate that and say that's, you know, that's absolutely it. I could stretch out to be in my top 100 and then go through a list of 100 different things. But the fact, if I can only keep it to one, I'd say to me the most important thing is, and everything is, you know, is important, but the most important thing for me is the leadership behind having a high quality tax practice. That it really starts from the management. You have to have a philosophy in place from management that says, you know, careless mistakes are not acceptable. That may sound like a harsh comment, but it's really not, because, you know, mistakes are going to happen. That's fine. I don't think we're not trying to prevent mistakes, and we're not trying to be perfect. What we're trying to do is eliminate careless mistakes that you can prevent by doing some of the things that Malcolm said, by making sure you have education, documentation, communication. And I'm actually going to add one more thing to that list, is systems. Because a lot of times if you put proper systems in place, they're designed to minimize careless mistakes. So if you kind of stick with these 4 pillars, and it's all wrapped around the leadership, you know, that management has the philosophy that careless mistakes are not acceptable, and that you're putting this framework in place, doing a periodic review on that to make sure the framework is well designed for your practice, and you're educating everybody within your organization, then I think that is the key. And it really comes back to the leadership of all this.
Yeah, thanks, John. I'm going to use one that I probably experienced very early in my career, but didn't fully appreciate it until later. I started with a small firm, and then I spent most of my career before CPA Canada with a national firm. But I think one thing that they did well, which I didn't fully appreciate until afterwards, was they were very good at understanding, and this again goes to education, but understanding what they knew, but also what they didn't know. They were very big about creating a network of other people, tax people and others in other areas as well, but who could help them. They recognized, that they had capabilities in some areas, but not others, like corporate reorganizations. They would involve other people. So it was interesting. I left my first employer and they became my first client when I moved on to the next position. But I think that is such a key thing. I said at the beginning, it not only as a risk management tool, but also an efficiency tool as well. So they were able to involve other people. They liked me because they had experience with me. But if you can find people that you trust and you can work with, they're a huge tool, because you can get them to focus on what they're good at, and you can focus on other things as well. I mean, there's nothing wrong with working in an area that you don't know as well, as long as you research it and all that. But you have to understand at the same time that it increases risks and probably may cause issues around efficiency as well. So I thought they did that very well. And like I said, I didn't probably appreciate that until later in my career when I specialized in tax. So despite all the best efforts, though, unfortunately, and I guess unfortunately, Malcolm, maybe we're sort of dipping into the horror story part again, but I see this also as a positive as well, that getting help when errors do arise will be very helpful in terms of dealing with the issue efficiently, but it'll also give you peace of mind too, that you have others that you can draw on if something does go wrong. But if a material error does arise, there are important things that need to be dealt with. And Malcolm, I'm going to turn it over to you just to discuss what are the key things that you need to do if you do find a material error.
Okay, thank you, Bruce. First, I'm going to say something. The comments by Sandy, John, and Bruce on both the capital dividend and the estate planning areas, if they somehow could be implemented by tax practices of each of the people on this seminar, it would avoid, I'm confidently would say it would avoid 90% of the claims that we receive. And they're not complicated advice that was provided. It was fantastic advice. And it's so, even though it seems simple, the implementation of all of those would avoid those claims. And why that's so important is, accountants are very, very conscientious people. And so I see when claims get reported, it really affects them, and it's very, very traumatic. And sometimes these claims last 2 years, sometimes these claims last 10 years. And so avoiding a claim goes a long way towards having a happy and successful practice. And so implementing these sort of, I would say, simple, practical, and very important advice by Sandy, John, and Bruce would be fantastic for your practice. Now going to what Bruce had asked me, let me talk about retention of files very quickly. So it's very, very important to retain your files as a documentation tool. Now, with the fact of being able to retain things electronically, I would say retain your files forever, because documentation is a key to a quick and early resolution of a claim. At minimum, for 10 years, you should hang on to claims, keeping in mind that there's often a long lag between when the service is provided and when the claim is advanced, especially when it involves tax planning. Oftentimes the second tranche of tax planning, which could be 5, 7, 10 years later, is when it's recognized that the first tax plan was a bit incorrect and could have been done more efficiently. As far as reporting a claim, it's very, very important to report it early to your insurer, keeping in mind that most claims are repeat offender claims. The insurance company has seen this in the past, and the insurance company often will employ a tax expert who will help you repair the matter or help you resolve the matter, and so you're not in it alone. And then I think John was talking about this. Engagement letters on tax services are very, very important. And it's oftentimes in the claims we see there are no engagement letters in the area of tax. First of all, you can use a limitation of liability clause, and it has been, the courts have actually upheld that when it's been used in a case out in BC. Secondly, it's very, very important to define the services you're going to provide, and then also define the services you're not going to be providing, and also who you're going to be relying upon. As John had mentioned, with estate planning, you may have another expert that's involved. You may get other parties involved, a lawyer or other parties. And so sometimes you're relying on your client, sometimes you're relying on this lawyer, sometimes you're relying on an R&D tax expert, sometimes you're relying on the prior accountant. And all those things, if you reflected those in your engagement letter, then the client fully understands what services you're going to be providing, what detailed work you're going to be doing. What's also very important is to make sure that your errors and omissions insurance continues for your estate. So oftentimes we'll see claims, and it's tragic to see this, where the spouse is already dealing with a deceased spouse who's the accountant, now has a claim advanced against the estate, does not know how to deal with it, and the estate has not carried on the errors and omissions insurance that was held while the practice was continuing. So that puts that individual in a very, very difficult position. Firstly, they don't know how to deal with this claim. They're probably not familiar with anything accounting, and now they have no insurance to cover the matter. So please be sure that as part of your own estate planning, to make sure that you have a provision in there to carry on your errors and omissions insurance for the estate. And then finally, what I'm just going to talk about, especially with estate planning, it's oftentimes to have good to have an indemnity and hold harmless agreement, especially when your relationship has been with the first generation, and now the second generation is getting more involved. And when you see there's a conflict between some of the second generation parties or between the second generation and the first generation, you don't be caught in the middle of that conflict. And so if the first generation recognizes that, they'll oftentimes provide you with an indemnity and hold harmless agreement, which will protect you if the second generation has a bit of an issue and tries to advance a claim against you. So thank you very much, Bruce.
Yeah, thanks, Malcolm. Yeah, maybe just a quick thing too. That's one thing I have noticed is sometimes tax advisors or general practitioners doing tax services, they don't realize that they may be in a conflict. And I think anytime that you're dealing with different generations as in estate planning, or maybe you're doing a transfer of a business as well, you are advising different people who may have different interests. So you need to make sure that everyone understands that. And if there are going to be differences, perhaps one or more participants have to get their own tax advice. It's really important to deal with that up front to make sure everybody's got a clear understanding what the expectations are. So that is an issue I've seen over the years as well. So I hope you found our discussion useful. We're about to do a Q&A session as well, but I just wanted to do a quick wrap up of just some of the plans that we have going forward in terms of resources. I've been talking about different things that we're doing, and it's part of our Practice Management Advisory Compilations and Tax Guide, the PACT. So that's available on the CPA Canada website. So I just wanted to highlight some of the specific tax resources that are either in there now or things that we're working on. So on engagement letters, we have put in a fairly good selection. We've got letters for specific compliance engagements, common ones like T2 preparation and that sort of thing. And we also have a generic tax consulting letter that can be used for different purposes. But I think the key thing is we can't predict all the things you're going to do. So when you use these letters, it's really key that you put in specifically what it is you've been hired to do if it's something other than the more generic ones. We've also created some key compliance checklists for the T1, T2, and T3. And as I mentioned before, we're also adding one for capital dividend elections as well. Our goal is to cover off the key, and I call it more compliance work. I think capital dividends probably a little bit of both planning and compliance, but we're trying to cover off the key compliance engagements first, and then we're going to take a look at where we go from there. The other thing, though, that we are going to put in, and it's to something John mentioned as well, either an existing client or a new client, it's important to know your client, and we have put together a client acceptance checklist that's in the process of being finalized as we do the recording. So we're looking at getting that into a future update of the PACT, and we're also looking at an estate planning checklist, as I mentioned before. And the new one, and John's helping us, it's an update of something we had before, which is a risk management checklist. We're trying to streamline it, and we're essentially what we're looking to do is take all, as I mentioned before, all the key things that were talked about today and some other things that we weren't able to cover and have them together in one place as a checklist to see what the key best practices are and trying to help you make sure you've covered all the bases. We also did want to do a more in-depth session on risk management as well. So we're still I think assessing what the best alternatives are there, but we are looking at doing a more substantial version of the presentation today, get into some of the more risk areas and that sort of thing.